Yeah, there's a lot of moisture in the air, so naturally the ball will take a lot of swings. So I think your editor will probably put some reverse swings also. But thank you for those nice comments, pun intended. I'm extremely delighted to be here. You mentioned about that this is the third one. I have a prepared speech. I will go through it. In between, of course, I will deviate and speak. And looking forward to the fireside chat and the questions from the FE team, as well as from the audience, if there are any. Shri Anand Goenka, the entire editorial, organizational, and the entire team from the Financial Express, distinguished members of the audience, ladies and gentlemen, good morning, namaskar. I am happy to be back at the Financial Express Modern BFSI Summit. I remember having participated in this event in June 2022, where I had spoken on disruptions and opportunities in the financial sector. The macroeconomic conditions back then were quite different and challenging, to say the least. As we were grappling with the overlapping shocks from the war in Ukraine and the surge in inflation at a time when the world was still recovering from the impact of the COVID-19 pandemic. Since then, we have come a long way. Amidst global challenges and uncertainties, today India stands out as a fast-growing major economy with stronger macroeconomic fundamentals and a healthy and resilient financial sector. The theme of today's summit, Decoding Inclusive Growth, aptly captures our combined aspirations for high growth with inclusiveness. During the next decade and beyond, the financial sector is expected to grow and play its role. This sector is a key enabler for the realization of our aspirations. With India's strong macroeconomic configuration, favorable demographics, and significant pace of digitalization, the Indian financial sector is poised to scale new heights. The recent annual financial results of banks and NBFCs indicate that the financial system remains sound and resilient. Further, macro stress tests conducted by the Reserve Bank reveal that the banking sector will continue to remain resilient even under stress scenarios. And the same applies to the non-banking financial company, that is the NBFC sector also. Now, in terms of market dynamics, the financial landscape in India is undergoing a structural transformation. And this transformation is primarily driven by factors like innovations in technology, financial deepening, and changing savings and investment patterns. Each of these shifts has a bearing on how financial entities carry out their business and adapt to the emerging risks. New and emerging technologies have reshaped the financial services industry by bringing in innovative solutions and personalized products. The demand-side factors such as rising consumer expectations for digital services and supply-side factors relating to regulatory support and emergence of fintechs have converged to drive a frictionless customer experience. The Reserve Bank has also been actively fostering innovation by envisaging mechanisms like the UPI, the regulatory sandbox, co-lending models, account aggregator framework, and several other similar initiatives. With the synergies provided by mobile phone penetration, internet availability, reoriented payment systems, and the multitude of customer data points, lending institutions as well as financial markets have been able to leverage upon such mechanisms to amplify their reach to the largest segments and also carry forward the agenda of a more inclusive financial sector. Overall, there has been a transformation in the banking and financial landscape in the last decade, which is driven by technological innovations, changing consumer preferences, and emergence of alternative business models. While these have fostered competition and collaboration, they have also implications for consumer trust and regulatory oversight. Such structural changes also create opportunities as well as challenges. Financial institutions like banks and NBFCs and others need to carefully assess the impact of these changes on their business models and on their resilience and sustainability. As Walter Weghorst said, adventure is the life of commerce, but caution is the life of banking. I repeat, adventure is the life of commerce, but caution is the life of banking. These words are relevant even today. As I have stressed in various fora, good times often sow the seeds of complacency and vulnerability. In my address today, I would like to present my perspective on some of the contemporary issues and emerging risks that banks and other financial entities need to address in today's context. There are 9 specific issues which I would like to highlight. The first one relates to loan and deposit growth. Let me first upon the current divergence between loan and deposit growth rates. It goes without saying that there will always be some gap between the two. But credit growth should not run ahead of deposit growth by miles. More so when banks are required to maintain CRR, SLR, LCR, etc. It is, of course, recognized that almost every loan creates a new deposit in the borrower's name or adds to his account balance, to his or her account balance. In other words, money begets money in the banking system. But the fundamental point is that there has to be a reasonable balance between credit and deposit growth. As I just mentioned, deposit mobilization has been lagging credit growth for some time now. This may potentially expose the system to structural liquidity issues. While there could be a debate regarding deposit funding loans vis-à-vis loans funding deposits, the current regulatory concern stems from the fact that there could be structural changes happening which banks and NBFCs and other lenders need to recognize and accordingly devise their strategies. Household and consumers who traditionally leaned on banks for parking or investing their savings are increasingly turning to capital markets and other financial intermediaries. While bank deposits continue to remain dominant as a percentage of financial assets owned by the households, their share has been declining, with households increasingly allocating their savings to mutual funds, insurance funds, and pension funds. To be precise, households are increasingly turning to other avenues for deploying their savings instead of banks. On their part, banks have sought to fill the credit deposit gap by increasing their reliance on other sources like short-term borrowings, certificates of deposit, etc. This increases their sensitivity to interest rate movements and poses challenges to liquidity management. The shift in deposit preferences from current account and savings account deposits, that is, CASA deposits, has various implications which banks need to keep in mind. With credit growth remaining strong, banks need to continuously focus on improving and refining their credit underwriting standards and pricing of risks. The second point I wish to highlight, which arises from the first point, is management of liquidity and interest rate risks. The 2023 banking crisis in certain advanced jurisdictions have brought to focus the risks of banking stability from certain business models and their inherent vulnerabilities. These incidents have also, I'm referring primarily to the banking crisis which we saw last year in 2023 in the United States and also in Switzerland. Now, these incidents have also triggered debates and rethink at the global level about design and calibration of the Basel III liquidity standards, deposit insurance, and resolution tools. Hence, it is imperative that our banks put in place prudent liquidity management measures proactively. It has to be borne in mind that incorrect valuation of liquid assets can give a false sense of short-term liquidity resiliency, which is not desirable. And whatever I am saying with reference to banks would be in a large measure relevant for NBFCs also. Now, the Reserve Bank, on its part, is reviewing the liquidity coverage ratio framework, that is the LCR framework, to address the emerging issues. This will be done after detailed public and stakeholder consultations. We will be putting in place a discussion paper or a draft circular and inviting your comments and comments of all stakeholders before taking a decision. In fact, that is the consultative approach which we have adopted in our regulatory actions in the recent years. In the latest annual report for the financial year 23-24, which we published in the month of May, there is a separate box item, and in the annex it has been listed, we have listed out the number of regulatory measures which were taken by the Reserve Bank and which were preceded by consultation with stakeholders. Interest rate risk is inherent to the business of banking. It goes without saying. Last year's banking crisis in certain countries, as I have said, have also shown the importance of managing interest rate risk in the banking book. The books of banks are highly sensitive to interest rate fluctuations. It goes without saying that banks need to manage their interest rate risk exposures using processes and symptoms commensurate with their business models, risk profile, earnings and capital levels, complexity and scope of their operations. The third point I wish to highlight relates to cybersecurity and IT-related risks. In an era of increasing technological footprint and rapid digitalization, it is critical that due emphasis is placed on managing cybersecurity and IT risks. Globally, there are growing incidences of cyber attacks on the IT systems of banks and other financial institutions. This necessitates high level of vigil and strengthening of the IT systems by banks, NBFCs, and other financial institutions. The Reserve Bank's supervisory assessments continue to stress on the importance of improving information technology governance arrangements, making the technology systems, processes, and infrastructure more resilient, and mitigating the third-party risks. Banks and other financial entities need to continuously invest in technology while also developing the right kind of capabilities to successfully tackle these challenges. In fact, one can even go to the extent of saying that going forward in a few years, the convergence between technology and on one side and the banks and NBFCs on the other hand, there will be greater convergence, and banks and NBFCs, to remain competitive, have to adopt technology, have to invest not only in technology infrastructure, but also invest in building up internal human skills and capabilities. The fourth point I wish to highlight relates to digital frauds. Another area of concern is the rise in digital frauds. Though many of such frauds are due to various social engineering attacks on customers, there is also a rapid increase in use of mule bank accounts to perpetrate such frauds. This exposes the bank not only to serious financial and operational risk, but also to reputational risks. Banks therefore need to strengthen their customer onboarding and transaction monitoring systems to monitor unscrupulous activities, including suspicious and unusual transactions. In fact, this is a point which we specifically discussed with the bank CEOs in the first week of this month, when we had interaction with the CEOs of both public and private sector banks. And it is necessary to monitor the transactions are being undertaken in various accounts. We have come across cases where an account, the volume of transactions is very less for a long time, but suddenly there is a spurt in the volume of transactions. There are also transactions taking place at odd hours in late hours of the night. Now, systems have to be built in, and I'm happy to note that banks are putting in place the required systems to monitor these kind of transactions which are happening, because they are potentially risky, and it has to be really seen why suddenly an account which was doing very few transactions and the balances or the account balance was low, suddenly how the balances go up, come down. There are fluctuations and there are too many activities and at very odd hours. This also requires effective coordination with law enforcement agencies so that concerns occurring at the systemic level are detected and curbed in time. The Reserve Bank is working with the banks and law enforcement agencies to strengthen transaction monitoring systems and ensure sharing of best practices of control of mule accounts and prevention of digital frauds. I would again impress upon banks as well as NBFCs and other financial institutions to ensure that necessary measures are taken, including for customer education and awareness, to maintain public confidence in the use of digital banking, in the use of technology in our financial sector. The fifth point I wish to highlight relates to third-party risks. In the current business environment, it has become necessary for banks and other financial institutions to outsource certain functions to third parties. While doing so, it is necessary to exercise strong oversight and monitoring of such outsourced activities. Regulations clearly provide that outsourcing of any activity by a regulated entity does not diminish the obligations of the regulated entity itself. Banks and NBFCs also need to consider whether cost optimization strategies are leading to overdependence on third-party vendors, even for critical functions, without commensurate oversight. We have seen a few instances of this and have dealt with it in the recent past. Strong governance and oversight mechanisms with regard to third-party relationships for both IT and non-IT services are essential components of resilience for any financial institution. The protocol with the outsourced agency should clearly define the roles and responsibilities of both the parties in such relationships. The Reserve Bank has already issued guidelines on IT outsourcing and draft directions on managing risks and code of conduct in outsourcing of financial services. The sixth issue relates to issues in unsecured retail credit. Now, I have attempted to highlight all the contemporary issues and touch upon them as briefly as possible. A copy of this address will be uploaded in the Reserve Bank of India website. So those of you, as well as your viewers who are watching this program online, you may have a look at this if you wish. Now, with regard to unsecured credit, I would like to say that the rise in the share of retail portfolio within the overall bank credit is a recent system-wide trend. As you may be aware, the Reserve Bank has taken certain preemptive measures in November last year to ensure that growth in these segments does not lead to potentially excessive risk buildup. These measures appear to have led to a certain degree of moderation in the targeted segments, as observed in our recent financial stability report. It needs to be emphasized that the delinquency levels and leverage in small-ticket consumer loans warrant enhanced vigil. Matters such as fixing limits on unsecured exposures are left to the banks and their boards. It is also left to the boards or the management of the NBFCs. It has, however, been observed by our supervisory teams that in some entities, it is noticed that some entities have fixed very high ceilings, even where they have already a high exposure. While it is not our intention to be prescriptive on such matters, banks and NBFCs are expected to show prudence and avoid any form of exuberance in the interest of long-term sustainability of credit growth and in the interest of long-term resilience and health of the concerned bank or the NBFC or other lenders, as the case may be. The seventh point relates to conduct-related issues. Fair conduct is not just a regulatory requirement, it's a core business requirement. I'm emphasizing on this issue because conduct risks may arise when the going is good, as it prevails now. Conduct risk needs to be seen together with risk culture. Fair conduct and practices foster consumer confidence and public trust in financial institutions, and they also strengthen their resilience and stability. The Reserve Bank has issued regulations from time to time to ensure fair and reasonable conduct by the regulated entities. In the recent past, guidelines have been issued on key fact statement. You would be aware that every loan we have mandated should be accompanied by a key fact statement which captures, broadly the significant material aspects of the loan, including in particular the annualized rate of interest. So guidelines have been issued on key fact statement, on penal charges in loan accounts, on reset of floating interest rate in EMI-based personal loans, and release of movable or immovable property documents on repayment or settlement of loan accounts. We still come across instances of regulatory entities resorting to high-handed recovery practices, framing non-transparent loan contracts with inadequate disclosures of important terms of non-disclosure of charges, levying excessive interest rates, especially in microfinance loans. Now, let me say that what I am pointing out, I would like to emphasize that what I am pointing out are cases are outliers. Overall, I can assure you, and I would like to emphasize and stress that overall, our financial sector, consisting of banks, NBFCs, and other entities, overall, they remain robust. Overall, there has been considerable improvement in governance, in risk management, in compliance, or in discharge of assurance functions in all these financial entities in the recent years. But we still see outliers here and there, which has to be, and in those entities, it is our endeavor to see that, compliance is ensured, there is better risk management, and there is, improvement in their governance. So overall, it should not be assumed that there is a big problem. Overall, the system remains very stable and healthy, but there are outliers, and what I am addressing is those, few cases which are outliers, which have a potential to sort of, spill over to other entities also. Now, critical issues relating to conduct sometimes get sidestepped in the pursuit of short-term gains. For instance, charging of very high interest rates by certain regulated entities, especially for microfinance loans, is not in order. I would like to reiterate what I said in my monetary policy statement on June 7. That is, regulated entities should use their regulatory freedom responsibly to maintain fair and transparent pricing of small value loans. Unfair or usurious practices under microfinance loans would compel us to have a relook at the revised regulatory framework for microfinance loans, which were issued in March 2022. The eighth point relates to transition financing. Climate change poses a growing threat to economic growth, and it needs immediate and sustained action on all fronts. Recent extreme weather events globally and also in India, such as heat waves, droughts, floods, and wildfires, are stark reminders that we have to take decisive actions. The Reserve Bank has initiated steps to address the risks posed by climate change to the financial system. Since we commenced this journey, several initiatives have been undertaken, which inter alia include issuance of framework for sovereign green bonds, acceptance of green deposits, and issuance of draft disclosure framework for climate-related financial risks. Going forward, our overarching approach would be to consider sustainability aspects as a focal point of the entire credit ecosystem. The onus of spearheading sustainability initiatives will, however, reside with regulated entities eventually. These entities have a crucial role to play in climate action by taking steps to provide climate finance. They need to explore innovative transition financing models. At the same time, they should also be mindful of associated risks and greenwashing concerns. In addition, the regulated entities may undertake transition planning to prepare for risks and potential changes in the business models of their borrowers who may undertake such transition. The ninth and the last point I wish to highlight relates to private credit markets. Private credit as a preferred alternative mode of capital mobilization is growing rapidly. It is emerging as an attractive investment avenue for investors with high risk appetite. While these markets may carry economic benefits by providing a greater pool of financing outside of regulated financial markets and institutions, and their risks appear to be contained at present, it is important to bear in mind that vulnerabilities and interconnectedness in these markets can amplify negative shocks and pose financial stability concerns. We continue to remain watchful of such developments and would welcome ideas and thoughts in this regard. In conclusion, I would like to emphasize that banks and financial institutions, NBFCs and others have a critical role in taking India to the next phase of economic growth. Regulated entities of the Reserve Bank like banks and NBFCs are well positioned today. I would like to emphasize regulated entities of the Reserve Bank like banks and NBFCs are well positioned today in terms of capital, asset quality and profitability to contribute to the economic acceleration which we are expecting in our country. Embracing technology and innovation while remaining focused on governance and risk management can ensure sustained capacity and resilience of the financial sector and enable it to meet the needs of our growing economy. While much has been achieved, there is still more to accomplish. With these words, I thank the Financial Express team for giving me this opportunity and wish the summit all success. Thank you. Namaskar.